Hi guys! Welcome to another episode of Financial Accounting Tutorials.
For this episode, we will be discussing about cash and cash equivalents, starting with the definition, items included, down to the preparation of bank reconciliation and proof of cash. Now, let's consider first by asking, what is cash? Cash includes money and its equivalent that is readily available for unrestricted use. Money is the standard medium of exchange and the basis of accounting measurements. Cash includes cash on hand and cash in bank. Cash on hand includes undeposited collections awaiting deposits and other current funds held as of reporting date. While cash in bank includes deposits in bank that are available for immediate withdrawal and unrestricted use. Items included in cash are coins and currencies, demand deposits, savings accounts, bank drafts, money orders, checks, and cash funds. Cash funds include petty cash fund, revolving fund, payroll fund, change fund, dividend fund, tax fund, travel fund, interest fund, and other types of impressed bank accounts used in current operations. Unreleased checks drawn or checks undelivered to the payees and post-dated checks or no payment has actually been made are included in cash. There is a need to revert the checks back to cash and accounts payable. Stale checks. These are checks delivered to payees that are not in cash within relatively long period of time, normally 6 months or more. Stale checks are reverted back to cash and therefore included as cash.
That's right. On the other hand, post-dated checks, IOUs or advances to employees, cash funds not available for use in current operations, and postage stamps are items that are not included as cash. Post-dated checks received by an entity do not qualify as cash because it is not presently available for immediate use. They will only be available for use at a future date. Unused credit line is not included as cash, but rather disclosed only in the notes. It is the difference between the amount of line of credit and the amount that was actually borrowed. Let's now proceed to cash equivalents. Cash equivalents is a short-term, highly liquid investment that are readily convertible to known amounts of cash and which are subject to an insignificant risk of changes in value. Cash equivalents must also be acquired 3 months or less before maturity. The standard governing this issue is the Philippine Accounting Standard No. 7 Statement of Cash Flows. These examples are of cash equivalents: 3-month treasury bill, 90-day money market instrument or commercial paper, and a 3-month time deposit.
Other important matters about cash and cash equivalents. Cash is recognized when it meets the requirement of asset recognition and it must be available for unrestricted use in current operations. Cash and cash equivalents are normally presented as current assets. Cash is measured at face value. If the deposits in foreign banks is unrestricted, they are included as cash at face value. Now, we take into deeper understanding to identify which are included or not in cash and cash equivalents. Here is an example.
The following information applied to Auto Company during 2016. Savings account, Manila Bank, 900,000. Checking account, Manila Bank, 1,200,000. Money market, 3-month maturity, 7,500,000. Currency and coins, 11,550. Commercial paper due in 60 days, 3,150,000. Cash fund restricted, 2,250,000. Petty cash fund, 1,500. IOU from employee, 2,000. And post-dated check dated January 15, 2017, 1,100. Post-dated check dated January 15, 2017, 190,000. So the amount that should be reported as cash and cash equivalents on December 31, 2016 will be savings account, 900,000, checking account, 1,200,000, money market, 7,500,000, petty cash fund, 1,500, commercial paper, 3,150,000, currency and coins 11,550, with a total of 12,763,050 pesos. So money market is included since it has a 3-month maturity date. Commercial paper is also included since it is due in 60 days. On the other hand, cash fund is not included because it is restricted. It should be noted that when cash is restricted, it means that it is not included in cash because it is set aside for special purposes. IOU from employees is not included as well because it is a receivable. Post-dated checks are also not included because cash will be available at a future time.
Petty cash fund is money set aside to defray relatively small amounts of cash disbursement. There are two methods of handling petty cash fund. First is the impress fund system. The impress fund system is a system of control of cash which requires that all cash receipts should be deposited intact and all cash disbursement should be made by means of check. But how do we account for petty cash fund? To record the establishment of a petty cash fund is debit petty cash fund and credit cash in bank. There will be no journal entries when disbursements are made out of the petty cash fund. To record the replenishment is debit to various account expense and credit cash in bank. The adjusting entry for unreplenished fund is to debit to various expense accounts and credit petty cash fund. There will be subsequent changes in the ledger balance of petty cash fund, whether to increase by debiting petty cash fund and crediting cash in bank, or decrease petty cash fund by debiting cash in bank and crediting petty cash fund. When there is a shortage in petty cash fund, the amount of replenishment is increased by the cash shortage in order to maintain the fixed balance of the fund. The entry is debit to various accounts and cash shortage or overage and credit cash in bank. While in petty cash overage, the amount of replenishment is decreased by the cash shortage in order to maintain the fixed balance of the fund. The entry is debit various expense account and credit to cash short or over and cash in bank. Now, we are going to show you an example of how we compute petty cash fund.
In November 10, 2016, the entity established an impressed fund of 10,000 pesos. The entry for this transaction would be to debit the petty cash fund 10,000 and to credit cash in bank 10,000. In November 29, the fund was replenished and the petty cash items include the following: currency and coin 2,000, supplies 5,000, telephone 1,800, and the postage 1,200. So the entry would be to debit supplies 5,000, debit telephone 1,800, to debit postage 1,200, and to credit cash in bank 8,000. Since there is replenishment made, then we credit cash in bank, but if there is no replenishment made, another entry will be followed. That is, we need to debit supplies 5,000, debit telephone 1,800, to debit postage 1,200, and to credit petty cash fund 8,000. Since there is no replenishment made, then we credit petty cash fund so that the cash content will be equal to the cash content of petty cash fund.
Now, let's proceed to bank reconciliation. What is bank reconciliation? It is a form of internal control over cash. It is a schedule prepared to account for any difference between the cash balance per books and the cash balance per bank statement. Bank reconciling items are deposits in transit, outstanding checks, and errors committed by the bank. No reconciling entries are made by the depositor for these items. Deposits in transit are deposits already made but not yet received by the bank due to cut-off, are not yet included or credited in the depositor's bank statement. And these outstanding checks are checks drawn and released but are not yet presented for encashment to the bank, and these exclude certified checks because it is no longer outstanding. On the other hand, credit memos, debit memos, and errors committed in the books are book reconciling items, and the depositor should make reconciling entries for these items. Credit memos are additions or bank credits made by the bank to the entity's bank account, but are not yet recorded by the entity. It includes collections made by the bank on behalf of the entity, proceeds from loans directly credited or added by the bank to the entity's account, and unrolled over matured time deposits transferred by the bank to the entity's account. Debit memos, on the other hand, are deductions or bank debits made by the bank to the entity's bank account but not yet recorded by the bank. It includes bank service charge, no sufficient funds checks, automatic debits, and payment of loans. Errors committed by either the bank, which is a bank error, or by the entity, a book error, would cause differences between the cash balances per books and per bank statement. Here's another illustration to understand the concept of bank reconciliation.
ABC Company is preparing its September 30, 2001 bank reconciliation. Information is shown below. Balance per book, 1,740. Balance per bank statement, 2,000. Collection on note by bank including 50 pesos interest, 1,150. Nsf check or not sufficient fund check returned by bank, 600. Bank service charge, December, 20. Deposit in transit, 780. Outstanding checks, 1,000. Additional information are: a 450 collection of accounts receivable was erroneously recorded in the books as 540. The actual amount deposited to the bank is 450. A 300 loan amortization of ABC Company was erroneously debited by the bank to ABC Company's account. As discussed earlier, book reconciling items include credit memos or additions to bank account, debit memos or deductions to bank account, and book errors. So the solution for adjusted book balance is: balance per books on September 30 is 1,740 plus collection of note by bank, 1,150 less Nsf check, 600 less bank service charge, 20, and less book error, 90, which is the difference between 540 and 450. And the adjusted book balance is 2,180. It should be noted that adjusted book balance should tie up with the adjusted bank balance. On the other hand, bank reconciling items are deposits in transit, outstanding checks, and bank error. So the solution for adjusted bank balance is: balance per bank statement on September 30 is 2,000 plus deposits in transit, 780 less outstanding checks, 900 plus the bank error of 300, which is the 300 loan amortization that should be credited to ABC Company's account. And the adjusted bank balance is 2,180 pesos.
Now we go to proof of cash. Proof of cash is an expanded bank reconciliation that includes proof of receipts and disbursement. It is useful in discovering possible discrepancies in handling cash over a certain period of time. To further understand the concept of proof of cash, let's have an illustration.
First, we need to place every balances in the respective column. Now, let's focus on deposit in transit. We need to add the deposit in transit of November 30 in the November column. Then, deduct it in the receipts side. The logic is, it is a receipt for November 30, so naturally, you need to add it in the November 30. But since it was only credited on the account in December, so we need to deduct it since it is not a December transaction. Then, for December, we just need to add it both in the receipt and December 31 column since they are transactions in December. For outstanding checks, the same treatment will be treated as the deposit in transit, but the only difference is outstanding checks are disbursement. so it will be a deduction to both November 30 and December 31 column. We also need to deduct the value of November 30 outstanding check in the disbursement column and add the December 31 amount. Bank services charge are deduction to the books account. So still the same logic as what we had in outstanding check, deduct it in November 30 column as well as disbursements column. However, for December 31, we need to add the amount in a disbursement and deduct from the December 31 column. Bank credit memo are addition to your account from the collection of banks from customers. In the first column, we need to add it so that it will not be understated. Then, subtract from the receipts column since it is a transaction from November 30. For the current month, we need to add it in the receipts column and December 31 column as well. Lastly, Nsf checks are bouncing checks. For the previous month, since it is really for the previous month but was only deducted on this month's balance, we need to remove it in the November column. Since it was recorded in the ledger as a disbursement this month, we need to deduct it. For the current month, since we are going to credit cash, so it is a disbursement, so we are going to add it in the disbursement column. And since it is a disbursement, we need to deduct it in the December 31 column.
Okay guys, we're done.
Thank you for watching and I hope you liked it.
Don't forget to like and subscribe for more videos.